When war breaks out in one of the most important oil regions in the world, people expect one thing: gold should surge. But this time it didn't. So the question is simple: why isn't gold skyrocketing? In fact, gold has even been struggling. In this video, we are breaking down exactly why the gold market is behaving very differently from what most people expected. Even though many of us focus on physical gold rather than trading, sometimes it's useful to borrow a concept from the investing world. There is an old saying among traders: the market moves before the news. The idea is simple. Large institutions and professional traders often react earlier than the general public. Not because of some rich man conspiracy, but simply because they have faster access to information, better tools, and more sophisticated algorithms. They start positioning themselves before most people even hear about a major event: wars, political instability, economic shocks. By the time the news reaches everyone else, a large part of the move may have already happened. So when many people suddenly expect gold to explode upward, it is possible that the market has already priced in that risk weeks ago. And in this particular case, the element of surprise was almost non-existent. Tension in the region had been building for a long time. Markets were already watching and positioning accordingly. But that is not the only reason gold may fail to skyrocket immediately after a crisis begins. Another factor is something many people don't expect. Sometimes investors actually sell gold during the early stages of a crisis. At first, this sounds strange. After all, gold is supposed to be the safe haven. But large investment funds don't only hold gold. They manage portfolios containing stocks, bonds, commodities, and many other assets. When markets suddenly become unstable, these funds can face what is called liquidity pressure. If other assets in their portfolio start falling, or if investors withdraw money, they may need to raise cash quickly. And to do that, they often sell their most liquid and profitable assets. Ironically, gold often falls into that category. This can temporarily push gold prices down or prevent them from rising immediately. We saw something similar during the early phase of financial crisis of 2008, and again during the market panic at the beginning of the COVID-19 market crash. In both cases, gold eventually recovered and continued its longer-term trend. Another important factor is the rise in oil prices. When tensions increase in the Persian Gulf, energy markets react very quickly. Because this region is one of the most critical oil supply routes in the world. Higher oil prices increase transportation costs, production costs, and eventually consumer prices. In other words, rising oil prices can create inflationary pressure. And inflation immediately brings another player into the picture: the Federal Reserve. If inflation begins rising again, investors may start worrying that the Fed will delay interest rate cuts, or in a more extreme scenario, even consider raising rates again. And for gold, that creates a problem. Gold does not pay interest. When interest rates are high, investors can earn returns simply by holding bonds or other interest-bearing assets. So even the fear of higher interest rates can temporarily put pressure on gold prices. This is one reason why, instead of clean rally, we sometimes see volatility. There is another important force at work, the strength of US dollar. Gold is priced globally in dollars. So when the dollar becomes stronger, gold automatically becomes more expensive for investors using other currencies. That can reduce demand and create pressure on prices. And again, this connects back to interest rates. If investors believe that the Federal Reserve will keep rates high, money often flows toward US bonds and other dollar-based assets. Demand for dollar rises and gold may move in the opposite direction, at least in the short term. Markets are not driven only by economic indicators. They are also driven by human behavior. During periods of uncertainty, there is an old saying in financial markets, cash is king, when investors fear markets might fall. Many prefer holding cash rather than being fully invested, not because they have lost faith in their assets, but because they want flexibility. Cash allows them to wait, to observe, and to act quickly if opportunities appear. In the early days of this conflict, many investors believed the war might be a short and limited operation. That is one reason financial markets initially reacted with surprisingly calm. But as uncertainty grows, investors begin adjusting their positions. Some sell profitable assets, including gold, to raise cash and prepare for possible market declines, often with one goal in mind: to be ready to buy the dip. But history teaches something important. Cash may be king in moments of panic, but gold has ruled through centuries of uncertainty. So what happens next? In the short term, gold may continue moving in a confusing way. Several forces are pulling the market in different directions at the same time. Geopolitical tensions pushes investors toward gold. Interest rates, the dollar, the liquidity needs push the other way. That combination often produces volatility instead of clear trend. But there is another important factor supporting gold in the long run. When we zoom out and look at the bigger picture, a very different trend appears. Central banks around the world have been quietly accumulating gold for years, and that is one of the main reasons for my confidence. According to data from the World Gold Council, central bank gold purchases in the recent years have reached some of the highest levels in decades. For example, countries like China and Poland have been steadily increasing their gold reserves. The People's Bank of China has added more than 200 tons of gold to its reserves since 2022. And the National Bank of Poland has purchased over 100 tons of gold in recent years. And central banks usually think in decades, not weeks. Of course, there is always a darker possibility. If the conflict turns into a prolonged war of attrition and energy prices rise dramatically, the global economy could face serious pressure, possibly even a recession. Historically, financial stress and economic instability tend to benefit gold. But from a human perspective, that is not something anyone should hope for. The humanitarian consequences of war, any war, are far more important than any market movement or financial gain. The reality is that during wars and geopolitical crises, uncertainty dominates the markets. One military operation, One political decision, one unexpected escalation can change everything overnight. So instead of trying to predict every short-term movement in gold price, many stackers focus on something much simpler: patience, discipline, and goal-term thinking. I'm curious to hear your thoughts. In times like this, what do you prefer to do? Buy more gold, hold what you have, or wait? And why? This is Old World Bullion from Europe. See you next time.